Hermes is probably the most valuable brand in the world, but you also have to pay a hefty multiple to call yourself an owner of Hermes.
And anyone who knows us knows that usually we stay away from stocks this expensive, but I have never seen a company that was able to maintain such a high valuation multiple over so many years.
I guess it's telling that their popular Birkin bags literally outperformed the market in most other asset classes over the last few decades. But one stock they couldn't outperform is Hermes itself.
We are on the hunt for high quality companies here on this show. And I'm sure you could argue about the definition of high quality, but part of it certainly is these businesses that defy the laws of economics or business. And really, when a company makes outsized profits, what we would normally think is that competitors will come in and profit will normalize. Those profits will be eroded away. That's the idea, typically what you would learn in a textbook. But some companies have what Warren Buffett calls a moat, something that protects them from competition and allows them to keep earning outsized profits. And companies that have done that successfully in the last decade or two have typically been the tech giants that we all know, building these self-reinforcing ecosystems that just make it incredibly hard for competitors to come into the market and take share. But there is another group of company that has achieved the impossible and kept those moats for much, much longer, not just a decade or two, but for centuries at this point. And of course, some people will know I'm talking about luxury companies. And when I say that, again, we could probably debate, what exactly qualifies as luxury, what qualifies as simply being a high quality or premium brand. And I'm sure we'll get into that today, Daniel, but it can already spoil today's pitch to say that this is a company that is without a doubt true luxury. And the pitch is for Hermes. And before we get into the pitch, though, as in recent weeks, I do want to just quickly remind listeners that we opened our 4th cohort of membership to the intrinsic value community. And there are only a handful of spots left at the moment, if I'm not mistaken. So I would encourage folks to hurry up and act on it if they're interested. And really, this is a community that Daniel and I built somewhat selfishly. We both realized that at some point, becoming a better investor is only possible through talking with other investors. And you can find many of them on social media, but the quality is always going to be questionable because you don't really know who's on the other side of the keyboard. And so we thought, why not leverage the relationships and the network and the audience that we have here, thanks to TIP and this podcast. And that's how we got the idea for the intrinsic value community. The community offers dedicated forums for stock ideas, weekly virtual calls on really a variety of investing topics, and then also sessions with expert guest speakers. And in the past, we've had folks like Adam Cecil, Alex Morris, and William Green. And so while the majority of content is online, membership also includes access to some private in-person events that we're very, very excited about, including dinners hosted by the Investors Podcast Network in Omaha during Berkshire Weekend, where you can come and dine with Daniel and I and many other like-minded investors, as well as some events we have planned in New York City next fall. But all right, Daniel, I'll let you take it away. Let's explore the world of ultra-high luxury.
We are 58 episodes in to this entire journey here, and Hermes is clearly one of the best companies in the world, so it was obvious we have to cover it at some point. And yes, if you look at the multiple, you might think, Daniel, this is simply too expensive, and it is not cheap. But if you look at Hermes's history, it has always been expensive, and its returns still crush the market. Over the last 10 years, Hermes's annualized return has been about 21%. The average PE over the same period has been 47 to 48-ish, so the premium you had to pay wouldn't have diminished your returns at all. But I also know that's a story of the past, so what we will try to figure out today will be whether we think it's realistic that Hermes can keep trading at such a high multiple, and thus it doesn't create a headwind for investors if they buy in at today's prices. There are generally many high-quality brands, but much fewer luxury brands, and actually even fewer true luxury brands. So you can actually look at the distinction from many different angles. Technically, they should all lead to the same result. We covered LVMH here on this show before, and it's a company that owns many, many luxury brands. Some are more prestigious than others, but if we just look at the core brand and at the stock, we see that in the first half of 2025, it was down almost 40%. That's also when we covered the stock here on the show. And it has recovered well since then, but even today, it's still 30% below all-time highs. And the point being is that if you look at the chart, it looks quite cyclical. Hermes's chart doesn't look like that at all. It's way more of a straight line upwards and to the right. So the fact that it's true luxury means it isn't really affected by economic cycles. And this would be probably the perspective from just the business fundamentals to judge how prestigious a luxury brand actually is. When we take the investor view, we can simply compare the multiples given to LVMH's earnings and those given to Hermes. LVMH sits at 30 times, Hermes sits at 50 times, and both are trading in line with historical averages, so you cannot say that one is trading at significantly higher multiples than usually. Investors realize that, Hermes offers a level of stability and predictability which is just higher than LVMH's, and they are willing to pay a premium for that. And then last but not least, you can look at it from the consumer side, which arguably is the most important one. And then I ask you just how many LVMH bags do you see outside? Because I see plenty of them. And if you compare that to how many Hermes bags you see outside, the answer probably depends on your social circle, but I don't see that many of them. And yes, I know they're a bit harder to spot because there is no obvious signature pen on them, which obviously we all know with the LVMH bags. But let me tell you, and you have to trust me here, you don't see that many of them.
And the point being there, usually you want to see people with your product and you want to sell as many as possible. But at a certain level of luxury, you actually aim to do the opposite, which is really counterintuitive. You want your product to be so hard to get, and to some extent, you just want to have control over who can buy it and who can't. And there's really this baked in kind of discrimination as part of the brand image of just not making it accessible to everybody. And so even whenever you see a Hollywood actor or a social media celebrity with a Birkin bag, which is the signature bag of Hermes, they paid for that bag. Hermes does not just send them to celebrities to wear, and it doesn't do any collaborations with celebrities either. And in fact, it's likely that they did not only just spend $30,000 on that bag, but probably multiples of that number on other products just to be able to get the chance to buy one of those Birkin bags.
This is not only a trend in fashion, this is actually also a relatively new trend in the luxury watch industry too in the last couple of years, where you could go into a Rolex boutique, ask for a watch, and then they basically tell you to just sign up for a wait list. You won't actually be able to buy the watch that you want, even if you have the money. And this has already been the case with even more prestigious brands, like for example, Patek Philippe for a while. But now other brands are doing the same. And Hermes is doing something similar. And you could probably say that they were the first doing it. And you can't just go into an Hermes store and then buy, for example, a Birkin bag. They won't give you one. You have to buy other products, often for years, before you even get the chance to buy a Birkin. And I know some watch collectors who actually hate this new strategy and just refuse to play it. And I think that's when it gets kind of interesting, at least from this economics and business standpoint, because it's kind of tricky. As a luxury brand, you need to know exactly where you stand and also who your consumer is. So if you're Patek Philippe or Hermes, for this example, the most prestigious brands in their respective sectors, you can play this game. You're so expensive that there's only this very small niche of people who can buy your products anyway, and they want to be special. They want to be not among the normal people with the same bags or watches. But if you are LVMH, and to some extent even Rolex, you're making most of your money with aspirational buyers, so people who are in the, let's say, upper middle class, and when they had a good year or they saved a little, they could buy your product. So those brands' sales volumes are just too high to attract the highest class of customers, and at least for the average product. So of course, Rolex also sells watches at prices only aimed at the top 0.1%. I'm not saying this is not happening, but for brands like LVMH, Prada, or Gucci, playing the waitlist game is somewhat risky. If someone finally saved enough money to buy their dream LVMH bag, then they go into the store and the employee tells them to spend it on shoes or a belt, or maybe get at some point a chance to buy a bag they actually want now in, let's say, 3 years. They're probably just thinking, that's BS, I will just buy a Chanel bag, or maybe not at all. And that's just a tough spot to be in. I mean, the most prestigious buyers, they prefer other brands, and you scare off the potential aspirational buyers because you don't give them what they want. But if a brand could start from scratch and choose which customers they want to serve, I'm actually quite sure most would go with the top 0.1%. And even if you look at the numbers, that's the fastest growing cohort of luxury shoppers in the world, with a CAGR of about 9% in the last decade. if you look at the aspirational customers, they only grew by a CAGR of 1%. So there's a clear tailwind for the high-end luxury brands in the entire market.
We've also seen a similar approach with our portfolio holding company, Ferrari, and we don't own it explicitly, but indirectly through Exor and EXOR, which is a company we covered a few weeks back on the show. And so anyways, Ferraris very much have this same true luxury component where there's a wait list to be able to get the product at all. And then actually there's such a culture of ownership around it that more than 80% of new Ferrari purchases are made by folks who already own or have previously owned Ferraris. So getting a Ferrari is like trying to get into this ultra exclusive club, especially if you want to buy a new one, and especially with certain collectible models. They only make those available to the most loyal customers that Ferrari has. And so I think now one of the most important questions is to ask, what marks the difference between luxury brands at the highest tier, like Hermes, Patek Philippe, or Ferrari, and all the others, apart from just selling fewer products? So what makes them so unbelievably special?
Well, most luxury brands, even many great ones, are just in the business of selling expensive products, but at scale. And the very top tier is more in the business of selling status, scarcity, and cultural permanence, if you want to say that. And with the product basically being the physical proof that you belong in a world that others just don't. And especially if you look at Ferraris or Patek Philippe, just the absolute amount of money you need to spend to get there is so high that most consumers will never even get into a Ferrari store and then think about buying that car. Probably that's also a reason why the criticism on their end with the marketing strategy is less so than other fashion brands like Hermes, for example, face. And generally, I would say that all luxury brands would say that's their goal, to, sell scarce goods, which are cultural permanence and basically giving you a feel of having something that other people don't own. But if you actually look at the numbers, it doesn't seem like they do that in practice. It doesn't work like that when LVMH sells 20 or 30 times as many bags as Hermes, and it's the same for Rolex and Patek. Patek sells about 70,000 watches per year. Rolex sells over 1 million. So scarcity is the first and also the easiest and potentially most important differentiator. In your Ferrari pitch, for example, you talked about how Ferrari sells one less than the market demands. And then what I described with the waitlisting approach is also called gating mechanism. And this is basically the idea that you build demand instead of harvesting it right away. And the difficulty with this is that it goes against just so many natural instincts of making money, especially if you are a publicly traded company. I mean, imagine sitting in an earnings call and telling an analyst that you could sell double the number of bags that you sell right now and at the same price. So you could basically double your business just like that. I would say it's very easy for the two of us to just sit here and then lecture on how they shouldn't do that because it would dilute the brand. But it's so much more difficult to actually stick to your strategy quarter after quarter for decades.
And the temptation is not only to immediately double your sales. Every luxury CEO would know that's bad for your brand reputation, but just even increasing them slightly each year is what also adds to that dilution over time. And when we talk about Rolex and LVMH, these are really the exception when it comes to being able to perfectly balance these marginal increases in volume while still maintaining scarcity and keeping pricing highs. So many other brands have otherwise failed at this, though. I mean, think about Burberry, for example. It had its signature print way overexposed in the early 2000s, which created this disconnect from the exclusive feeling that luxury buyers wanted when they were paying up for it. And then fortunately, the brand staged a pretty successful comeback by reducing the usage of their signature print in products and marketing going forward. But I mean, that is a case study in its own right on how not to do things in the world of true luxury.
Yeah, it definitely is. But I mean, it also shows, if you look at it just from the other side, that luxury brands can actually rebound. I mean, that's very difficult for most other retail brands. I mean, Nike is currently trying to do it, and Nike is certainly also not your average retail brand, although it's, of course, not a luxury house. In fact, they have a similar advantage to some of the luxury brands, and that's history. People just like a good story, and something you can't copy is long dated history. And even when we last talked about Nike on one of our calls in the intrinsic value community, I was thinking about why so many people, what they think about when they think of Nike. And for a lot of them, it's actually ads and this kind of feeling that you can do whatever you want when you wear those Nike shoes that they advertise on TV. So It's history, and it's also a feeling that you get from wearing these shoes or just clothing. And I think back when we covered Moncler, which was this Italian outdoor luxury brand a while ago on this show, and we mentioned how almost all luxury brands initially started building niche products for certain industries. With Hermes, that industry has actually been horse harnesses. In 1837, Thierry Hermes started a workshop to build the best harnesses possible, and he was obsessed with just the high quality materials and the craftsmanship. So even almost 200 years ago, Hermes was catering to elite customers only, and the product has changed today, obviously, but the promise that as an Hermes customer, you get the highest possible quality has hopefully not changed, and it doesn't look like it whenever you look at their bags and how much customers like them. And I think it's quite funny too that the company's first crisis was the automobile. So when we talked about Ferrari, you mentioned in a very far bear thesis that cars, at least the ones that you potentially drive yourself, might face the same fate as horses back then. And it kind of looks like that hit MS.
And now things close full circle there because the fate of horses was the first crisis of Hermes.
Yeah, it's hard to imagine now, but harnesses or just saddles back then have obviously been a mass market product, even though obviously not everyone had a horse, but they were just the go-to thing that you needed to do if you want to get around. And obviously saddles were quite important for that time. And then that suddenly was in a very sharp decline when the automobile came. But instead of going down with the harnesses business, MS and also its experience and expertise basically led them to expand into other leather businesses. So what's interesting about that is that by pivoting, MS pricing power increased quite significantly. And it turns out that no matter how good your product is, if it's a utility product, you are competing with other harness makers on price and availability. But when you're selling products that people buy because they're either beautiful or because they last and kind of just carry a kind of quiet status, then you don't compete one-on-one with any other company. A Chanel bag is not an MS bag. It doesn't matter how similar they look to their customer bases. These are completely different things.
You also told me that the founder of Hermes, Thierry Hermes, is actually half German, and that's an interesting fact. So why are we talking about a French luxury giant today and not a German one?
Well, Thierry's father was French, and that probably served him well because there's certainly no German name with as much class as Hermes. So I think building a luxury brand was definitely easier with this name than a typical German one. But jokes aside, I mean, his story was actually quite dramatic if you look into it. While he was born in what's now a German city, in 1801, it was still under French control at the time. So he was actually a French citizen, not a German one. And a pretty sad part of the story is that he ended up being an orphan after his parents and all five of his siblings died. And this was, and it's kind of crazy to just think about it, the time when Napoleon conquered countries across Europe. So talking about history and storytelling, that's the time we are looking at when going through Hermes's history. And Thierry's family died after fighting in the war or by diseases, and there was just no functioning, as we can all imagine, health system anymore. So they didn't stand a chance, and he basically grew up an orphan.
It's a tragic story. And actually, if I remember correctly, the story of Louis Vuitton is similar. I think he also grew up an orphan, and that led him on this journey of building Louis Vuitton later on. And what's interesting about Hermes and its roots is also that to this day, it is still primarily French businesses run by the Hermes family. Is that right?
It's actually the sixth generation of the family running the business today. Even the pivot from harnesses to all sorts of leather products wasn't made by Thierry himself anymore, but by his grandson, Emile Maurice. So at that point, you already had the second generation taking over the business. And it's pretty remarkable that today, far over 100 years later, 70% of shares are still controlled by the MS family. What's a bit confusing is that they don't carry the name MS anymore. There are actually three different family branches now. And the MS CEOs, they always came from the same one, which is called the Dumas branch. And yeah, the family business heritage is probably one of the most important factors of MS's success because every heir of MS has to begin his or her career as an apprentice in production. We're not talking about a little internship, as it usually is done in those families. They have to spend a decade in production before they can take an executive position. I don't think I've heard that anywhere else before, and I think it gives you kind of an idea of the culture that is still alive, basically, in that company.
Gosh, well, I first have to say, I'm not sure what's up with everybody abandoning their family names. The founder of Fiat's grandson, John Elkann, seems to have changed his name from Agnelli to Elkann, obviously. And maybe it's to create some distance from family and try to appear independent and distinct as their own person. Or maybe it's to just try and create some distance from that feeling of nepotism and making that a little bit less obvious, but I don't really know. But LVMH is certainly not approaching succession in the same way as Hermes, though. I remember that Arnault's kids, Bernard Arnault, the CEO of LVMH, and his grandkids got their executive positions relatively early on in their careers. And so the production of Hermes products, and especially the handbags, is more of an art than anything. And clearly they want future leadership in the company to be trained on building those products by hand, which is a little bit different than what we saw at LVMH. And so I've heard of the one man, one bag policy, which means each bag is handled by a single person. And so Adam Smith would criticize this process, but in a world where every product is divided into dozens of different repetitive tasks that are done in different parts of the world for efficiency gains, this is really a unique selling point, and it turns every bag truly into a one of one, which is just not something we have in this world anymore. And the artisans even sign the bags by leaving a little mark with each one. And so to be eligible to actually build a bag for Hermes, you have to go through 18 months of initial training, I read, and only after 5 years from that are you considered to have enough expertise on leather and saddle mastery to really be working on your own. So even if Hermes wanted to increase volume, which is not on their to-do list, I don't think, there's simply a limit on how many bags you could build in this very traditional way.
As you know, my co-host Shawn and I are obsessed with analyzing companies. But you probably have noticed from personal experience that talking stocks is not everyone's favorite hobby. And I'm reminded of that every time I bring up investing at dinner or when I'm out with friends. They tolerate it for about 10 minutes, but then I get this look. The one that says, we get it, you love stocks, but this is not the place. So Shawn and I thought, why not build that place? And we did it. It's called the Intrinsic Value Community. Our members range from pilots and firefighters to lawyers and engineers, but also hedge fund managers, actual rocket scientists, and CEOs. And despite those different backgrounds, what connects all of us is the passion for value investing and continuous learning. And each week, we host live calls, covering everything from vetting the group's best stock pitches to analyzing portfolios, investing case studies, and conversations with expert guest speakers who are either prominent portfolio managers, CEOs, or authors. And the best thing is that if you ever miss a call, we have a library of recordings for watching back every single call we've ever hosted. And if you prefer reading over watching, well, then we have dedicated spaces in the community to share write-ups, discuss investing ideas, or just your thoughts on the general market. And multiple times a year, we bring the community from the virtual world into the real one, including private dinners in Omaha for Berkshire Weekend and meetups in New York City to explore, hang out, and most importantly, talk stocks. Our last cohort of members brought together 20 incredibly thoughtful people, some of the sharpest investors that Shawn and I have ever met. And if you want the chance to learn alongside people like that, you should join our waitlist at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community.
Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout.
Yeah, it's one part of why I said it's so important that it's still a family business. Because if you would sell this and I just see a consultant coming in, the first thing they would do is take manufacturing and put it into some Asian country where it costs significantly less money than it is right now. One more thing about the names. In this case, the Hermes name didn't make it because at some point there were only three daughters and no son. And since many, many decades ago, it was still tradition that in a marriage, the wife has to take the husband's name. The Hermes name was abandoned. On the manufacturing point, another crucial part is that it's done almost exclusively in France. Like I said, that's not the case for most other luxury brands, even if the tags say made in Italy, made in France. That doesn't necessarily mean the bag was actually manufactured there. It's often enough to just perform the final assembling in those countries, but the individual parts, they were still manufactured in Asian countries like China or Vietnam, for example. So that's definitely not the case for Hermes. 80% of products are fully manufactured and assembled in France, and the other 20% of goods, like watches, which come from Switzerland, or footwear from Italy. So it's still about ensuring just the highest quality of product. And obviously, everybody who knows watches know the highest quality of watches, they will come from Switzerland. Footwear, some form of clothing, they're just the best in Italy. So that's why you move this manufacturing outside of your home country. Everything else is still being done in France.
I want to double down on the idea that it's just so hard to even get these bags. Even if I were to just walk into a store with more than enough money to buy them, I wouldn't get one. And so, I mean, if you think about how we normally approach things as consumers, if I walk into an Apple store, the best case scenario for Apple is that I probably leave with a few Apple devices, some sort of subscription to Apple Music and iCloud and Apple TV. That would be a dream sales day. And so it's just crazy for me to think about, based on how we understand businesses to work, that companies like Hermes will straight up just tell a customer who is willing to spend money that they can't. And that clearly shows that I'm just not immersed enough into the luxury world to wrap my head around this fully. But I mean, I just imagine, what is the process like when I go into a store like that? What actually happens? If they're not going to sell me the product I want, why am I going there? Let's say I do want to buy a Birkin bag. What would they tell me? How would I actually go about eventually getting one?
First of all, I think a Birkin bag would suit you, Shawn. Maybe you should go for one and at least give it a try. But no, honestly, it's just a completely different world. So if you walk into the store and you never purchased anything from Hermes, they will not sell you a bag. And we're not even talking about selling you a Birkin bag. They will likely not sell you any bag. Of course, they won't blatantly tell you that. They likely just say they don't stock those bags right now, at least in the store, or something similar. What you can buy are scarves, bracelets, watches, essentially accessories that show your commitment to the brand. And it kind of feels like a leveling system. You have to start with the basic products, then you level up, and eventually they might give you a call saying that a bag has come in and they invite you to the store. And then it's really some sort of ceremony. So you will sit there in a private room, the employee will showcase the bag, you drink some champagne, perhaps eat some cake, and then you have the chance to buy the bag that's offered.
So that's crazy to me because you can't even decide which one you exactly want, right? Like, so if I want a blue one and they only have an orange bag, let's say, is that truly the only one I can get?
Yeah, you can't say I want a specific color or a specific feature. Either you buy the one that they have there or you don't. And this is basically what happens in the high-end watch boutique too. Sometimes they have more than one, then it's your lucky day. And I say it's luck because obviously it's not pure luck because they know and can decide whether they want to offer you a bag or even multiple of that because let's be honest here, we know they have them there, but you have no influence over it. And honestly, I totally get the frustration of customers. I would honestly feel somewhat disrespected if that happens to me. And to be brutally honest, 90% of the people who feel disrespected, well, they are simply not the target audience of MS, me included, obviously. And this is pretty much the difference between an LVMH bag and an MS bag. You can save money. You can go to the LVMH store and then you can buy that bag. You know that you will leave the store with the bag that you want. And that's where you see thousands of them in every big city in the world. You don't look at people with an LVMH bag and think, gosh, they must have a ton of money. At least for me, I know that I think when I look at them, yeah, they likely spend their monthly salary on that bag, which, just for context, it's totally fine. It's an aspirational product and you buy it for yourself, for example, as a reward for something, or you achieved something and you thought, okay, I want to buy this just for me. But that's not how an MS bag works. An MS bag is supposed to signal that this person really has money. Not only because he or she could afford one of those bags, but also because they were allowed to buy one of those bags. By the time you're considered for one, you likely spend 5 to 10 times the amount of money on other MS products. And add to that, MS makes money from repeat customers. So if someone has a Birkin bag at home, chances are pretty high that they have 10 other MS bags too.
And that's sales strategy. I think it also protects them from the secondary market, right? I could imagine Hermes keeps a really close eye on where these bags show up. And if someone is clearly buying them just to flip them for a higher price, then I presume that person basically just gets cut off. They're cut out of the system. There's no second chance to buy another one, probably. Because from Hermes's perspective, the resale market is a double-edged sword. It reinforces the desirability and value for sure, but it also bypasses their ability to gatekeep access to the product. And so it gives people access to a bag that Hermes deliberately chose not to allocate to them in the first place. And so the more that happens, the more that dilutes the whole relationship-based distribution model that this is premised on. So the fact that hasn't unraveled after decades and centuries now at this point, I think is really impressive how they've maintained that.
It's another tricky balance that you as MS just gotta strike. And on one hand, you still have to treat your customers well. And on the other hand, you have to keep some of these very strict rules in place because you might risk diluting your brand otherwise. And that's really the worst thing that could happen to a luxury brand. And as you just said, if you are basically existing for as long as MS is existing and they still have the same reputation, that just means you do an incredible job of balancing those two things. And if you just look at the resale price, for example, for a Birkin bag, it's hard to speak about dilution at all. Birkin bags have outperformed the S&P 500 over the last 3 to 4 decades with an average annual return of 14%. So they sell for hundreds of thousands of dollars online, which is just, it's insane. And whenever that's the case, it obviously helps with the reputation of a brand. If you can sell that bag for $300,000 and you bought it for $20K, that's obviously an immensely good thing for your reputation. However, to keep that reputation in place, you have to have these strict rules because if it's seen as an investment vehicle, it opens up yet another customer base that would buy from MS. Me, for example, I would probably not buy a Birkin bag, if I could even buy one, to then, go out with it. But if I know this outperforms the S&P over 4 decades, I might do it. And if we're being honest, those are not the type of customers that MS wants to attract. So yes, it's good for reputation, but only if supply on the secondary market is probably even more limited than coming directly from MS. And you can see all the sales practices as both sales strategy, but also as kind of a self-defense mechanism for the brand. And yeah, it makes a lot of sense for MS to just stick with this, even when 90% of people think this is beyond ridiculous.
I think this also comes down to knowing who your customer is. One of our largest portfolio holding companies is Adobe. And there are some viral tweets you'll see from time to time in threads online about these marketing and sales strategies that Adobe has where basically they just make it harder for people to cancel and even charge high fees for doing so. And so as a consumer, that's super annoying. And I don't think a company with a quality product like Adobe necessarily has to do that to keep their customers. But my point really is that even if that's true and it costs them some individual customers on the margins who maybe churn to Figma or Canva, that's not the target group for Adobe. That's not what they're optimizing for. And so that doesn't actually invalidate the underlying argument or thesis for the business in the sense of what matters for the investment case. Their primary customers are these large corporations and Hollywood movie studios and large marketing agencies. And so it's very different than optimizing what, the individual retail consumer would appreciate the most from a customer service perspective. And so I think it's similar for Hermes in a way. The average consumer might think these are just outrageous sales techniques, but these techniques don't matter to the main customer base. And in fact, in Hermes's case, they're actually important to the main customer base and keeping them attracted to and interested in the products.
I think there's basically a 0% chance that MS will ever change these tactics because this is what makes MS so attractive, just as you said, to the people that are actually the customer base, that actually want to differentiate by owning MS products. And all of that said, I watched some videos of how people basically prepare to go to MS. And preparing means here that they put on all the stuff they own by MS and they basically create this strategy on what to say and how to act to get offered a bag when they go to the store. So, for example, you don't want to immediately ask for a bag, apparently, because otherwise the employer will just go to the bag, they will say they don't have any in stock, and then that's it. Instead, you ask about some other products before, then you get into a conversation, then you slowly mention the bags. And I couldn't help but feel some kind of secondhand embarrassment when I went through all of that. I mean, just to hope an employee decides to grant them the privilege of buying the product, all of that just doesn't seem too worth it to think about what do I wear, what do I say. I don't know. It seems insane. And by the way, we only focus so much on this process because I feel that from a brand and a cultural standpoint, this is probably one of the bigger risks for MS. I don't think there are a lot of risks with this company at all, but if you want to pinpoint one, perhaps it's this one. I mean, at the end of the day, it's a $200 billion company, and ultimately, such a big company needs volume too. And you can't just sell to long established customers who have been buying at MS for basically generations. You gotta have new customers as well who are first time buyers. And I know from the watch sector that there are a lot of people who could afford these watches and they still don't want to buy them because they feel they're not being treated well enough. And when they enter these stores and they have to buy stuff that they don't actually want, it just such a bad experience for them. They just don't buy a watch at all. And if this happens on the margin, it doesn't really matter. If it becomes more of a bigger thing, it could actually hurt a brand.
Yeah, I think it's gone beyond just customer dissatisfaction. In 2024, Hermes got hit with a US class action lawsuit that basically targeted the exact sales dynamic we've been talking about. The plaintiffs argued that getting a Birkin is not just about paying the sticker price. It's more like a pay-to-play system where you're nudged to buy other Hermes products first to build a purchase history with no guarantee you'll ever then be offered a bag. And so they tried to frame that as an illegal tying arrangement under antitrust law. And Hermes, though, denied wrongdoing, of course, and argued that Birkins are handmade and scarce, and allocations to loyal clients is a selective retail practice, not just a antitrust violation. And so in September 2025, we saw a federal judge in San Francisco dismiss the case with prejudice, though the plaintiffs filed an appeal afterward. I can see how the argument saying that Hermes uses tying arrangements in this case, and really that why that would be illegal. But on the other hand, I do think it's a common practice in luxury fashion. And as a brand, I think to some extent you do have the right to decide who you actually sell your products to.
That kind of gives me flashbacks to my law lectures back in the day. This should be about, I think the term was invitatio ad offerendum, which is Latin. So basically goods displayed in a shop or a store, even with a price tag, are basically treated as invitations for customers to make offers, but not as binding offers by the seller. So that basically means the shop or the store can refuse the sale before a contract is concluded. And if that's correct, I hope my law professor would be proud of me for still remembering this. But it is generally just an interesting point. I don't want to open a cultural debate here, but I also think that, I don't know, social media has made people think that they are maybe entitled to some things. So when they see their favorite influencer with an MS bag, they want one as well. So they save to get one. And then you're suddenly confronted with this totally different sales strategy. And of course, it feels kind of unfair and maybe also weird. But for the brand, they just want to make sure that the same group of people as before get access to their products still.
The question is somewhat redundant, but I assume that Hermes will then sell exclusively through its own stores, right? And then how does online shopping work in this scenario? Will they only offer products that you could also buy directly in the store? And then how important is it to appear in person to build a relationship and be noticed that maybe enables online shopping down the road? I mean, I would love to hear how any of that works.
Usually, retail brands, they either sell DTC, so direct to consumer, or in wholesale stores. And that just means that there's a store which offers multiple brands. So luxury brands, usually, as we said before, they go for DTC because it gives them way more control over the brand image and also the checkout process. So you get all the data, which is important, especially if you work with waitlists. Unsurprisingly, as I just said, for companies like MS, this is basically what they need to do. So we're talking about almost 100% of their stores, of their sales being DTC. There are some exceptions. So for example, sometimes you might go to an airport and then you see a wholesale store. And if you go in there, you may find a couple of, let's say, MS products like perfumes or watches, but there's no signature MS product. And the online store is interesting as well because, by the way, you should check it out. The website looks really great. At a time when most companies try to save money or just, get some quote unquote cool new generated AI websites or ads, MS really doubled down on its basically image of craftsmanship and art. And they actually hired an artist to redesign the entire website with hand-painted visuals and illustrations. And it's a detail, but I guess, this is luxury. So details matter and it looks great. I just like to see it. And in terms of sales volume, the online shop is not that relevant. I think it's about 10% of revenue. So considering that about 75% of people who buy something on the website are first-time customers, I think of it more as maybe an introduction to the brand. So MS is very much about the physical experience. Their flagship stores also look incredibly good. So it's just an experience to go in there. And then if you offer the bag in, let's say, 10 years time, maybe if you want the Birkin bag still, you can get to one of these private rooms, get the full experience of buying something from MS. And I must say, I never set foot into one. Usually what Shawn and I like to do, especially when we talk about retail brands, is going to the stores, maybe talk to some people in there or to, the staff in there. But I went to the store here in Hamburg and there weren't a lot of people in there. So I stood in front of it and I felt like, gosh, you couldn't buy anything in there. And just going in there to annoy employees who usually even turn down people that are willing to spend $20,000 on a bag, I thought it's probably enough if I just look at it from the outside. And so I didn't go in.
I'd probably do the same, Daniel. And actually, as you're talking, I was thinking, man, they must have had a lot of internal debate about just if and when they would ever open an online shopping place, right? Whether they'd ever have a website. And I'm kind of surprised that they do. But anyways, given the brand's strong focus on this French heritage that they're very proud of, is there still a major focus from a business perspective on the French market specifically? I'm not sure I know what the exact brand perception is in the US beyond it just being a symbol of extreme, maybe extravagance. I know my wife probably dreams of owning one. And I guess I would need to change my social circles a bit to actually find more folks who are seriously talking about buying these products. But I did want to ask about China because most brands, including luxury brands in particular, have pivoted to the Asian markets and especially the Chinese market in the last maybe 15 years. And I would imagine Hermes has had to do the same to stay competitive.
The last few decades have definitely brought quite significant differences in both product mix and also the geographic distribution of sales. So back in the 80s, over 50% of sales were driven by the silk and textile section. So ties, scarves, shirts, all of that stuff. Today, obviously, leather goods are by far the biggest category. And within leather goods, obviously, we're talking about the bags. That change was mostly started by longtime CEO Jean-Louis Dumas. And he led the company from 1978 to 2006, so pretty long tenure. And under his watch, the famous Birkin bag was introduced. And this was not only a huge hit in France, where in the 70s and early 80s, still almost all of the company's sales came from. This has also been a huge hit in international markets as well. So first and foremost, we're talking about the Asian market. So today, as you just alluded to, as with almost any other brand, about 50% of sales come from the Asian market and mostly just China. And we sometimes talk about how growth in Asia has to be judged by whether it comes with the same margins as in Europe and the US. And in Hermès' case, the Asia Pacific region, which again is mostly China, is actually the most profitable market they operate in. So margins in Europe and the US are in the low to high 30s. China is closer to 50%. And the main reason for that is probably just the store economics. So when you look at a retail business, usually you look for metrics like revenue per store, revenue per square meter, revenue per employee, and maybe product turnover. And Asia is the market where Hermès has the greatest demand relative to supply. So that essentially means that every incremental unit or store you allocate to that region has a very high probability of selling through quickly and at full price. So Unfortunately, MS doesn't report exact store counts by region, store sizes, or revenue, but I've played around with the numbers that we do know, and I made some assumptions here and there about the store size and revenue, and I think it's not unreasonable to assume that MS generates something between 60 and 80,000 euros per square meter of their stores globally, and that's a ridiculously high number. So just to give you some perspective, brands like Lululemon, which is a company we also covered here on the show, and it's one of the companies in our portfolio, they actually generate about $16,000 per square meter. And if you look at luxury fashion market, it's close to $30,000 to $40,000. And if you look at Apple, which is often crowned the king of store economics, it's at somewhere in the 50s to 60s. So realistically, that's the level where MS is to at a minimum. Maybe it's even beyond that.
To a much lesser extent, it does remind me of my experience at a store when I was in Tampa the other day in the Hyde Park area, which is actually a very, very nice part of town there. And so anyways, I'm sitting there with my wife and her cousins peruse the jewelry thinking, man, they have like maybe a couple dozen items that are actually out for display across this entire store. And it wasn't like a super small store in an area where I'm sure rent is definitely not cheap. And I just remember thinking, man, unless they're charging some crazy prices for this jewelry, I'm not sure how this makes any sense. And as you can imagine, that was exactly what they were doing. I went to look at just a single necklace and it was like $10,000. I didn't think it looked like anything special, but yeah, that was the price they were charging. So if they can even just do a few sales a week, they can clearly sustain that kind of business. But it's just very, very different from how we're used to thinking about retail. And so changing the subject a little bit, looking at the last few quarters, it does seem like growth in China is slowing a bit. And so my question for you, Daniel, is do you think that's just a normal seasonality and maybe some tougher comps? Or does it feel more structural to you? And related to that, China has obviously been the big growth engine for luxury over the past decade. And if that tailwind is moderating, where do you see new incremental growth coming from? I mean, is there a China-like opportunity on the horizon? You could imagine India or parts of Latin America or Africa boasting much more robust future spending on luxury. But yeah, I don't know. How do you think about it?
Well, before we get to the geography part of the growth equation, I would first like to just take a chance and talk about the MS store count, because this is yet another thing that makes no sense based on what you learn in Business 101. MS store count has actually declined from a peak of 311 in 2019 to 293 last year, and yet revenues still compounded at roughly 17% over that period. So when we talk about companies like Lululemon or Nike, we can often use store counts as a rough proxy for market maturity, and it also correlates with how much revenue, obviously, they can generate. With MS, that logic kind of breaks down. So it kind of reminds me of what you said about Ferrari in your episode. So most luxury car brands want the prime, the easy to access location in a city. Ferrari doesn't really care. They know customers will come to them anyway. And I think MS feels the same way. They think about it in terms of they don't need lots of stores. For the big ticket purchases, aka the bags, they will just call you and you will literally come to them, often at one of their flagship stores, so they don't need all of these different small ones in tier 2 cities, basically.
I think that was my favorite tidbit that I came across about Ferrari. And it was something Guy Spear shared in an interview. That's why I remember it. But I can't imagine stronger proof of a brand moat than being able to literally pull customers to you in that way.
Yeah, it's pretty amazing, especially if you talk about purchases that are still very high priced, but we're not talking about a Ferrari. I mean, technically, I could buy the car, get in, and then drive back home. Within a mass bag, you can get called to just a different city, and you will still make that trip because that's one of your few chances to actually buy one of their bags. And it's just incredible. And in terms of slowing growth in China, there are basically three things that affected the numbers in the last year or two. The first is what demand in just greater China looks specifically for MS. The second is simply the mathematical effect of comparison basis after a very strong period in 2022 and 2023, basically after the pandemic, where growth rates were in the high 20s to even the high 40s. And the third is whether what's happening is macro softness or more of a permanent change in how Chinese consumers engage with luxury as a whole. And I think the only one that would actually hurt Hermes in the long run would be a genuine perception shift, meaning the brand loses relevance at the very top end of the Chinese luxury consumer. And there isn't much evidence, if any, that this is what's going on. What Hermes has highlighted is more a change in traffic, store traffic, especially in Greater China, which matters because Hermes, as we said before, is still unusually dependent on the in-store relationship for converting demand into sales. So, if less people visit the stores, you cannot just sell more online. That's not what they do. Again, only 10% of sales are generated from the website. So the store is where clienteling happens, where you build purchase history, and where basically the allocation of scarce leather goods is managed. So when traffic softens, obviously the growth rate will also slow down. And just on that comparison point again, it's important to remember how distorted the last few years were, especially in China, more so than in any other country in the world. At the end of 2022, you had these closures and the restrictions were largely gone. And that's when you see an immediate spike in growth reaching over 40%. MS was actually the company that recovered most from all luxury companies in China. And then when you move into 2024, you're comparing against a year that was just unusually strong. So just mathematically, the growth rate should normalize, even if the underlying business remains as strong as basically ever. But that explains, to be honest, only part of why the numbers slowed, because if you look at the numbers in 2025, you would expect them to reaccelerate, but they didn't do that. And I guess the simplest explanation is that the Chinese consumer environment has been weaker overall. And luxury demand in China has been softer across the board, not only for Hermes, not only for fashion, but just across the entire luxury industry. And it's also worth separating, at least to some extent, that China demand is not necessarily Chinese demand. So what matters is not really where you buy, but only if people that are from China originally stop buying Hermes products. And if spending migrates to, for example, overseas markets due to travel patterns, because as I said, the economies open up again, you can travel again, and especially the wealthy people will do that, well, then you can just, get some more sales in other parts of the world. I mean, Japan, for example, has been very strong, and likely some of that is probably due to Chinese tourists buying Hermes products, simply not in China, but, in Japan. And I suspect this effect is probably smaller than you would imagine for brands like LVMH, because again, you can't just go into a store, we say it for the 10 times today, when you're, for example, on a vacation and then you buy a Birkin bag. And it's probably also why you don't see the Daigou phenomenon. I think we talked about this with Estee Lauder and LVMH. And obviously, this is not as much a part of Hermes. And just for our listeners who don't remember or didn't listen to those episodes, first of all, you should. But if you didn't, here's what Daigou is. I mean, it's basically a gray market personal shopper model. So someone buys luxury goods in lower price or just more accessible markets, oftentimes abroad, and then they resell them back home in China. And with Hermes, that's just harder to scale because the products people want, most of them you cannot get. And actually, if you look at LVMH, this business model has been a huge driver for them in terms of China sales and basically Asia as a whole. And when that practice was basically broken down by regulators, it was a huge hit for LVMH. Once again, because Hermes is much more exclusive, and this practice, just because of how they operate, couldn't really bear fruit with that brand. You also didn't get the hit when the Daigou was basically regulated away.
I feel like we have a few companies where just such a big part of the thesis is based on success in China, from Nike to Lululemon. And gosh, it just makes me realize how much more homework we need to be doing on the Chinese market. But on that note, how has competition performed in China? We know from many fashion brands that China has been just a really tough place to be for the last few years. But how did it look for the broader luxury sector? And in the end, you pay these premiums for luxury companies because they are supposed to not get caught up in the same economic cycles that affect everybody else. And yet here we are talking about economic cycles.
Well, especially in the highest tier of luxury, where Hermes certainly sits, you would expect this. When we look at Kering, for example, which is essentially a Gucci-centric story, we saw a very sharp decline in the region in the last year because Gucci is both more exposed to aspirational luxury and also more dependent on just the fashion cycle and the momentum in fashion in general. So when traffic slows and the consumer turns maybe just more cautious, those brands tend to feel it much harder. LVMH was more or less flat, and in theory, I would rate most of LVMH's brands to be aspirational too, and therefore see a more significant reaction to lower consumer spending. However, LVMH owns just so many different brands that you obviously have this additional diversification effect where some categories hold up better than others, and they basically balance the downturn. So I think for those companies, it definitely showed how hard business has been in China for the last couple of years. If you look at a company like Brunello Cucinelli, which is an interesting reference because it's closer in positioning to the ultra luxury, not very shiny, but high quality bucket that you probably can also put Hermes in. Well, Brunelli was able to keep growing in Asia. However, I would say that these numbers are not only for China, but for Asia in general and overall. And we also can't ignore the fact that they started from a much lower base of just 350 million euros in sales. And obviously, Hermes is just significantly larger and it's easier to grow the pie when it's significantly smaller in the beginning.
So I think the important point is that you don't see the lack of growth in recent quarters as a structural problem for Hermes and more so as part of a weaker macro environment. And usually what you would expect to see from a brand that's losing ground are signs that it's losing pricing power or that it increases product volume to keep sales stable or growing. And here, it seems like more than one of those normal luxury down markets, which by the way, industry experts have also been highlighting. So just coming back to the question of the next incremental growth markets for them, China feels relatively mature at this point. So are there other geographies that could become that next major demand engine for Hermes? I know I kind of asked you about that earlier. And related to that, for someone who is not naturally drawn to ultra luxury fashion, especially me, of the both of us, I'm curious whether Hermes is seeing the same kind of demand from younger generations or whether the brand tends to just attract older customers where then there's a question of like, hey, is this a kind of a melting ice cube that they're holding on to?
By now, we've looked at, I would say, quite a lot of brands that have used China as the major growth engine in the last few decades. And when I compare that to other economies that we've looked at, so for example, South America, I feel like China had a very unique combination of scale, speed of wealth creation, a retail infrastructure build out that just allowed brands to put down an enormous footprint in a relatively short period of time, and also just a cultural adoption of luxury as a status language, which probably not a lot of people expected from the quote unquote communist China. So if you combine all of that, at least to me personally, it seems very difficult to find any other place that can offer all of these circumstances. Perhaps the closest one, although in earlier stages, obviously, would be India. I mean, India is growing very fast and there's a very wealthy segment of the population. And more than other luxury brands, Hermes doesn't necessarily need a wealthy middle class. So they cater to the top 1%, arguably, especially in emerging markets, probably the top 0.1%. And I know that sounds kind of bad, but just judged by the business model, that's how it is. So LVMH, Gucci, Prada, they all sell to large parts of the upper middle class as well. And Hermes is doing so to a much lesser extent. And another thing that I think about, and maybe some luxury experts here will disagree with me on that, is that I don't believe Hermes actually needs a single geography to basically replace China in order to keep compounding, because the business is fundamentally supply constrained. So it's more about allocating resources than opening up completely new markets. So if one market is cooling down, Hermes would simply reallocate the bags that they have to pockets of the market where demand is still high. So let's say you imagine you have a full wait list in a dozen countries, and then in one country, for example in China, the wait list is shrinking. Well, then you would just sell your products to the more crowded wait lists and then wait for the slower market to pick up speed again. And that's basically what you can do by just reallocating the product that you have. And I'm not saying that Hermes doesn't care about opening up new markets. If India becomes a significant part of Hermes's business over, let's say, the next 10 years, that would definitely be great. But Hermes doesn't need that to happen to just continue growing in, let's say, the low double digits. I mean, we often speak about call options, and I think expanding into new markets would be such a call option for me.
So you'd expect double-digit growth driven by mostly price increases, obviously, and then slight increases in volume potentially. And should any market turn out to be the new China, then that would be, like you said, this kind of call option on future growth that could maybe support another decade of high teen or low 20s growth. Is that really how you think about it?
That's how I'm thinking about it. I mean, price increases have historically been mid to high single digits, depending on the year, and you can still expect mid single digit increase in volume too. So that's how you would get to that growth rate. Yeah.
All right. Based on that, I mean, I assume you also don't expect any headwinds from younger generations being less interested in high-end fashion and bringing down volume over time.
Actually, younger generations, they are very interested in fashion and also high-end luxury brands. I mentioned earlier that I suspect social media is part of the reason why some of these high-end brands have really doubled down on the waitlist approach and building a history with the brand. Because, of course, that has always existed to some extent. But when I think about my parents' generation, especially my grandparents, I think they just wouldn't have had even the idea of buying something at Hermes if they couldn't afford it, or if they just wouldn't be part of a social group or circle that usually goes there shopping, basically. And I believe that has changed, at least to some extent. So when you open social media, you see many influencers that at first glance, and this is basically what they do, look just like you, but they wear these high fashion brands. And because of that, a lot of people want that too. So I think that was a bit different in the, I don't know, 70s. I mean, back then, Hollywood actors wore those brands and you knew you were not like them. That has changed to a large extent. So I actually think demand for these products outside of the traditional customer base is growing too, and probably more so than it has ever been in the past.
It's a really interesting point. I mean, I think it's not just a gut feeling. I've seen studies that show something similar. Bain and Company, for example, found that Gen Z has the highest purchase intent for luxury brands right now of any generation. And so you also discuss the long-term trends among aspirational buyers versus truly wealthy people. And so I think that's also really interesting. And I would love if you could put more insight into that.
So short term, you have clearly seen that trend in 2025. Aspirational customer spend on luxury goods was basically down 35%. And they were not spending nothing at all. They were just spending it on different goods, not necessarily on luxury fashion. But there's a much larger underlying trend behind this that actually shows once again how difficult it was for MS to stay the course, but also how it's exactly why it is untouchable today as a brand. And when all the other luxury brands went down, MS basically is still trading at 50 times earnings. So most luxury brands have, I would say, doubled down on democratizing luxury goods. So they advertise to customers in the upper middle class. And in the short term, that obviously boosts your numbers enormously. It's a much bigger market than just the top 1%. And you didn't necessarily have to discount because people, especially after COVID, they just had a lot of savings. So at first glance, everything would look great. Basically what we talked about before, more sales, more profits, no discounts. But even then, you are diluting your brand just by giving too many people access. And exclusivity not only means you sell your goods without a discount or at high prices, it also means to just seriously limit supply and not go for the extra dollars, although they look attractive. And a while ago, as I said before, we discussed Montclair here on the podcast, and they are basically taking, I would say, an entirely opposite approach to MS. They do a lot of promotion with celebrities, which is something that MS doesn't do at all. And they want to appeal to customers with these flashy designs and even public appearances as marketing. And many of the luxury fashion brands, even the ones with long-standing and traditional history, have also followed the, I would say, streetwear hype. So basically, they are following the customers. And I know that a lot of people here, especially working for TIP, they know and they love the book Luxury Strategy. And you would know that luxury brands, if you read that book, they shouldn't do that. They shouldn't follow the customer. Again, MS doesn't even sell you bags when you're in the store with the money, willing to spend it. And maybe that's where another misconception is coming from. Perhaps some people think that MS isn't maybe popular with Gen Z because they don't follow these brands. But such trends have always been there, and usually they come and they go. MS customers, I would say, they appreciate it for not taking part in them. And to some extent, I would also call it natural selection. So even in the upcoming generations, the people who make real money, they will likely appreciate exactly that about MS as basically all other generations have before.
I think there's a timeless component to luxury. You know, you're tapping into some aspect of human nature that is just enduring, and that is to want to be at the top of the social hierarchy. And then these symbols we use to signal that can be extremely lucrative businesses. And so Hermes is really positioned as the ultimate symbol, I think, which from a shareholder perspective is very, very compelling. And that brings me to ask about their financials and capital allocation as managers of this incredible business, right? There's no doubt that they've managed the brand tremendously well, but I want to really zoom in more on the capital allocations and the financial profile. And, you can imagine that, unsurprisingly, the margins at least look outstanding, 70% gross margins. And then at the same time, though, some of the kind of fundamental measures of health for the company, I think, are declining. And that is to say the store count is declining, which on the other hand does make supply more limited and maybe actually has this counter effect where it makes the product more desirable. I don't really know how to think about that, but they also don't do any marketing. And so it sounds like to me most of the line items that retailers usually spend money on are just really non-existent expenses or very small shares of overall revenues for Hermes. And I suspect that is really part of the reason cash has compounded at a CAGR of 25% over the last 10 years. And on the one hand, that's obviously great for a balance sheet that looks really good, but especially since Hermes has no long-term debt, meaning that cash is more than double the entire liabilities of the company. So you really don't have to worry about this company going to bankruptcy at all. But you could also argue that hoarding that much cash does seem like an ineffective use of capital, potentially due to really the lack of reinvestment opportunities that they have before them.
MS definitely doesn't take the maybe typical fashion brand path, but it is investing quite a lot of money. I mean, the two main buckets are production capacity and then the controlled distribution network. And both of these are more capital intensive than one might imagine at first. So when there aren't many new stores built, you would think that they don't spend a lot of money on that line item, but the renovation of existing stores alone costs more than 600 million euros in 2024, and that's about double the amount for any given year. So usually this position would be closer to 300 million euros, but then you also spend another 200 million euros on building new workshops and training new artisans. And when you have some overhead costs too, I would say you can quickly reach about 800 million to a billion euros a year in investments on that end. And obviously that doesn't sound much when you have a 200 billion euro company, but you shouldn't forget the 50x multiple. So free cash flow is about 4 billion euros. And compared to that number, I think a billion a year doesn't look like a small reinvestment anymore. And besides that, MS also pays a dividend, but similarly to Ferrari at these multiples, it's not a game changer. Despite spending, I think, 1.6 billion euros on the normal dividend last year and then adding another billion on a special dividend, the yield was still below 1%. And at the end of the day, I think I even like the fact that they just keep more cash instead of buying back shares or paying out dividends when the yield is just very low. So in case you ever get a pushback on the stock, you actually have a lot of cash that you can then use or deploy at significantly higher returns than spending billions of euros now to buy back shares at a multiple of 50.
Well, we've seen this problem before, and it's absolutely not the company's fault. But if you think just intuitively that a company is paying out, let's say, $1 per share in profits, well, if you can buy a share in that company for $10, then you'd be getting this excellent 10% dividend yield. But if the market values those shares at $1,000, something kind of ludicrous, maybe akin to how Hermes is being valued, maybe not quite that extreme, but still, you're getting only a 0.1% dividend yield. And either way, what I'm trying to say is the company is trying to return the same amount of dollars to shareholders. But the more extreme the valuation, the less impactful those capital returns actually are on shareholder returns, which is usually a sign that the stock is too expensive for us. It's a pretty good heuristic to use. And the logic also is the same with buybacks too. Buybacks made at higher valuations are not going to go as far when the shares are trading at such pricey valuations. So speaking about valuation, I think it's time we get into your model. You always do such a good job building models for us to look at, Daniel. And yeah, I'd be very surprised, I think, if you told me Hermes looks cheap. But I would say it's a stock that's not meant to look cheap. And it hasn't had to look cheap to still be a great investment. And its multiple actually has been relatively stable for decades now. And that is a very premium multiple, by the way. So I think it's fair to value it with some assumption that the market will continue to pay a premium for this business. And then the question is, what is a reasonable multiple to bet on from a fair value sense, and at what point do we have any kind of margin of safety where we feel like even if we're paying a premium to the market average, we're getting access to the stock at maybe a discount to real quality it deserves.
One of the most impressive things about MS is the fact that you could have bought this company basically 20 years ago at the same very large multiple, and you still outperformed the market. So I think, what stock, if not MS, earned its right to trade at a high multiple, and you think it will likely stay that way for a long time? Having said that, we basically sat here a couple of months ago talking about Ferrari, and just 2 months after we covered it, if even, the stock dropped 30%. So it can happen to any company. Although I must say that I think MS is probably even more durable than Ferrari. But with Ferrari, you can still at least paint a bearish scenario where many, many years into the future, cars that are not self-driving might lose significant relevance. And in your episode, you talked about how driving a Ferrari might become what horse riding has become, more of a fun luxury hobby. And even in the short term, you have the EV threats hanging over Ferrari. So that's basically why the stock has gone down, one of the reasons at least, basically 30% since October last year. And I don't see similar risks for MS. ESG is obviously a constant concern, but if anything, MS is at the forefront of sustainable manufacturing. And just considering the lack of overall risks, I think there's an argument to make that most of MS's value lies in the terminal value of the company, meaning that it is very likely to perform at rates higher than, for example, GDP growth for a very, very long time, much longer than most other companies. And what we usually do to value companies is we forecast 5 years of revenue and earnings or free cash flow, because that's a reasonable time frame for us to forecast. Everything beyond that feels basically more like a gamble. And we then use a multiple, an exit multiple, at the end of the forecasted period to come up with the valuation. And I usually prefer that approach over a terminal growth rate because it feels more tangible to me. I have a long track record of multiples that the market was willing to pay for a company at any given time, in any given scenario. And I have a much harder time assessing when a company will just stop growing faster than GDP. Will it be in 5 years, in 10 years, in 20 years? I just have no idea. And if you take a company growing at 10% per year and expect that in 5 years from now, that will go to, let's say, 2% forever, you might underestimate the potential quite significantly, at least for the next 10 or 15 years. And with MS, it's a bit different because I would bet on MS still being around and growing at high single digits, even in 20 years from now. And it's difficult to capture that in a model. When I just go through our usual approach, I expect a revenue CAGR of, let's say, 9 to 10% and a net income margin of about 34% in the base case. And in my valuation, you will see that I model out each business segment, but I don't think we need to go through all of that. Those are the key numbers, the most important ones. If you're interested in all the details and even changing my assumptions, you can download the model in our free weekly newsletter, which is also out today. And yeah, I would say at high single digit top line growth, a 34% net income margin, and an exit multiple of 40, which is slightly below the historical average. And then we still use our 8% discount rate. And I know it's a lot of numbers, a 20% margin of safety, you would get a fair value of about 18 to 1900 euros per share.
So at the time of recording, the price is about 2,200 euros per share, which looks like it would imply a mid-single digit return, which does not meet our hurdle rate. But I think you're not done, though. Tell me more about the rest of the valuation before we make a conclusion.
Yeah, the base case is a mid-single digit return, not coming close to our 12% hurdle rate. I mean, in a bull case, I kept the multiple and the margin of safety that we use somewhat the same. So it's not really a highly unlikely bull case. It's more so maybe a somewhat optimistic base case. And then I calculated with just mid-teens sales CAGR and a 38% net income margin, which is a margin that we already have seen with the business before. And at that point, you would get 2,700 euros per share. So that would imply a 13% return. And this would basically only mean a reacceleration to 2024 levels and then margin increases over time. So I think this is realistic, but even then it would just barely cover or maybe overcome our hurdle rate. And then for the bear case, I dropped the multiple to 30 times, which is still above the S&P and is still somewhat of a premium multiple. Sales growth to 6%, which is also not unlikely if you see a kind of sustaining slowdown, especially in the bigger markets. And then net income margins, they stay at today's level of 30%. And then you end up with a stock that is only €1,000 per share. So that's quite a significant downturn from where you're standing today. So I guess long story short is that this is a multiples play. I don't expect a sudden 20% growth rate. So it basically all depends on the multiple that the market is willing to give Hermes. And if the market keeps valuing Hermes at a low 40s multiple, I think you can expect easily high single digit returns, maybe low double digit returns. If the multiple drops, there's definitely some way to go to the downside.
And I guess expecting that the multiple increases further is not likely or not something you want to bake into the types of assumptions we like to have in our model just out of the sake of conservatism, especially not looking at longer term. But how differently would the valuation look when using a DCF approach with a terminal growth rate? Have you really thought about that?
Yeah, I did it. And I mean, using a terminal growth rate only makes sense when we work with a longer forecast period. So I forecasted the financials up until 2035. I revised the growth slightly to 8%, and I kept margins stable at basically 2030 levels. So we're talking 34% net income margins. And then I used the terminal growth rate of 3%. And after discounting, you would still, quote unquote, only get a fair value of €1,800. So the result is very close to the base case exit multiple approach, at least when you use the assumptions that I use. And again, you have the chance to download the model, play around with the numbers, and come up with whatever fair value you want, basically.
I think Hermes is an incredible company. I actually think I like it more than LVMH, which is a company I pitched months ago, I think in the summer of 2025. Anyways, what I like more about it is just the singular brand focus. There's no distraction, right? LVMH is, more like the Berkshire Hathaway of luxury, where it's this serial acquirer model of folding more and more brands into this massive conglomerate that just I think it ultimately gets very messy, and it's easy to lose track of some of the brands and allow them to be diluted. And there's also a huge alcohol component to that business. I mean, it's not like a majority of revenues or anything, but it's a significant part of the business. And there's all kinds of interesting data coming out about how alcohol consumption is very much changing worldwide, and people are drinking less than they used to. So anyways, there's all these different kind of interrelated reasons that I feel less and less excited about LVMH over time, but I think I do feel really excited about Hermes and just this idea of a singular focus on craftsmanship, one brand, one, identity around it. That is a really compelling sales pitch. And then, of course, there's the question of the multiple. And so you're not going to catch me buying Hermes at 50 times plus earnings. This is the tricky thing about investing is like, I have friends and family that will ask me about stock picks and like, hey, would you recommend, should I buy Hermes? If I'm looking at a probability distribution, most likely buying Hermes at 50 times earnings, assuming you hold it for, let's say, a decade, I'm sure most people would do fine. The contingency there is, did you actually hold it for a decade? And secondly, you're setting yourself up where there is a range of probabilities where you just get absolutely flattened. And that's really what we're trying to minimize on this show. That is our whole approach to investing, is thinking about the range of probabilities and to what extent can we reduce the likelihood of us just absolutely getting destroyed on an investment. And if you buy it 30 times earnings, I could say with a very high degree of certainty, you're much less likely to get destroyed on an investment than if you're paying 50 times earnings, even for a company like Hermes, assuming everything else equal in those two comparisons. And so I am one who has never complained about paying up for quality. I'm happy to do it. And I would love to pay up for Hermes in this situation. I think the current valuation strikes me as just not as enticing as we would like relative to the other reinvestment opportunities in our portfolio. We've seen Adobe sell off a lot. That's a company I would probably love to add more to. And there's so many other exciting companies I know that we are thinking about covering, that I'm not at a point where I feel like the best use of our capital, the best allocation of a spot in our portfolio would be to add Hermes at its current valuation. But just, this is very non-technical analysis here, but just looking at the valuation multiple for the company since something like 2015, pretty much any time the stock dipped below a 40 times PE, and especially 35 in the earlier part of that decade, you had some instances where it fell toward like 33 times earnings. Those clearly look like setups to me where the stock is very attractively priced because you're paying something that is much closer to a normal market multiple for what is, truly a one of a kind business. I don't know. I think at around like 40 times earnings, I could probably start to swallow like a tracking position in it. And then something, on the lower end of 30s, I would get really, really excited about adding Hermes to the portfolio, knowing that they can very comfortably grow into that multiple and have a very high likelihood of sustaining an elevated multiple to the market for an extended period of time. But that's just my two thoughts.
I totally agree with almost everything you said. I think if there's one point that I consider to be very underappreciated with Hermes, it's the management team and the culture. And it's hard to grasp and it's obviously intangible. But if you think about how many quarterly meetings there have been in which the management could have decided to just increase volume on how much they sell slightly more and have never done so, I think it's underappreciated how many good decisions the management team has made. And if you compare to almost all other luxury brands out there, basically all of them eventually start selling a bit more volume, getting a bit more dilutive. And you just talked about LVMH. And I think to me personally, it's a great company, but every single brand that they keep on acquiring will dilute the overall LVMH brand a slight tidbit more than they were before. And MS is just this one perfectly managed brand, which is probably just a one out of one, basically like all their bags. And I think it's a fantastic company. And over the long haul, I would just love to own the stock if it comes down from the current multiples, because right now, as you have said, we just have no margin of safety on this. When we looked at Ferrari, it was trading at a similar multiple to Hermes now, and only a couple of weeks later, it dropped to low 30s in the multiple. And the stock is now closer to being 30% down. And this happens to even the best companies. There are not a lot of times when you can buy Hermes at multiples in the low 30s, as you just said. In fact, the last time that happened was a decade ago, but still, I don't want to build, I think, a tracker position here now. And as you just said, for a full position, it's too expensive. I'm just missing the margin of safety. And this is not a stock that is expensive because it will grow a lot. It's really just about the reputation of the brand. And I know it was obvious before the pitch that MS is expensive, but the idea of this show is to build a portfolio, as everyone who's still listening to this podcast right now probably already knows. And for that, you'll need a lot of good companies on your watch list. And when you've done the work to then react when the prices drop, that's a very good situation to be in. And when that already happened, it might be too late to do the work. And you want to be prepared. We are now prepared on MS. That's why we look at these companies even when they trade at a premium. So I think we don't add it to the portfolio yet, and we both hope it will have the same fate as Ferrari, and we can buy it in the low 30s at some point. But that's it. Shawn, now I think if you don't have anything to add, that would be the part where I ask you about your hints for next week's episode.
Fingers crossed we get that low 30s Hermes multiple. I don't know if we'll get it, but gosh, that would be awesome. We'll send an emergency update in the newsletter if the day ever comes. But looking out to next week, I always say this, but it's one I'm really excited about. Otherwise, I wouldn't be pitching it. It's a company that I know really well as a consumer, and I don't think I'm special for that. I think most listeners will feel like it's a company they know very, very well. I know Daniel knows it very well too. And yet we have managed not to cover the business yet. And it's not a Mag 7 company, but I will say it did used to be in one of the market defining acronyms, as you might put it. So this is probably getting way too obvious, but it's a company that nearly every household uses, dominates their TV consumption. And then now the stock has fallen around 30% in 6 months at the time of recording this episode. So it does feel appropriate to take a look, but I'm sure I've spoiled it. But that will be the pick for next week.
I'm pretty excited for this one because there's so many people talking about it, but I haven't yet seen a valuation on it. So I'm just very excited if it actually is as cheap as, the price drop in the last couple of months would suggest. And I think that's it. I would say I'll close it today with a quote by Carolina Herrera, who is a Venezuelan-American fashion designer. And she said, luxury will always be around no matter what happens in the world. And That might be true for an industry, but as investors, we need to find a luxury brand for which this holds true as well. I really do think it's a mess, and probably there are not many others, but at 50 times earnings, I do not yet want to bet on it. That's why we made our decision. Next time, we look at a company that's slightly more cheap than this. So stay tuned and see you all next week.
Thanks for listening to TIP. Follow the Intrinsic Value podcast on your favorite podcast app and visit theinvestorspodcast.com for show notes and educational resources. This podcast is for informational and entertainment purposes only and does not provide financial, investment, tax, or legal advice. The content is impersonal and does not consider your objectives, financial situation, or needs. Investing involves risk, including possible loss of principal, and past performance is not a guarantee of future results. Listeners should do their own research and consult a qualified professional before making any financial decisions. Nothing on this show is a recommendation or solicitation to buy or sell any security or other financial product. Hosts, guests, and the Investors Podcast Network may hold positions in securities discussed and may change those positions at any time without notice. References to any third-party products, services, or advertisers do not constitute endorsements, and the Investors Podcast Network is not responsible for any claims made by them. Copyright by the Investors Podcast Network. All rights reserved.
And the thing with true luxury is that in some cases, the more you raise prices, the more attractive the products actually become. And long term, Louis Vuitton can probably sell more purses at $2,000 than it would if they were priced at $500 because of that luxury positioning I'm describing, where the higher price tag signals a whole bunch of things that end up making customers only want to own that item more. And at a lower price, the product would fundamentally be less attractive, which is kind of crazy to say because it's less exclusive and implies that maybe it's just a premium item and not a true luxury one that comes with all these other status symbols around it.